Usually when we talk about a medical diagnosis, there's this expectation of absolute precision.
Right. Yeah, like it's binary.
Exactly. You fall, your arm hurts, you go in, and the X-ray shows that jagged white line.
Hmm.
The doctor just points to it and says, there is the problem. Broken or not broken.
It's comforting because it's visible. You can just neatly categorize the reality of the situation in an instant.
Yeah, but then you look at the broader U.S. economy right now, and suddenly that X-ray machine feels completely busted.
Oh, totally busted.
We are operating in a diagnostic landscape that is, honestly, it's murky at best. I mean, if you're sitting there trying to figure out if the American consumer is healthy or sick, the macroeconomic signals are just, well, they're flashing in every contradictory direction at once.
It is the definition of muddy waters. I mean, you've got sticky inflation anxiety on one hand, volatile oil prices on another, and these shifting expectations about Federal Reserve interest rates swinging back and forth every single week.
Right.
All of these high-level metrics just make it incredibly difficult to get a clear, grounded picture of what is actually happening in the real world.
Which is exactly why we were taking a different approach for today's deep dive.
Yeah.
To figure out if the economy is actually sick or healthy, we are putting Ally Financial's newly released Q1 2026 earnings report right under the microscope.
Yes.
And if you're thinking, wait, why should I care about a bank's corporate accounting? Well, here is the secret. A bank's quarterly earnings report isn't just a spreadsheet. It is a real-time behavioral MRI of the American consumer.
That's a great way to put it.
It strips away all the theory, and shows us exactly where the money is flowing, who is actually paying their bills, and what people are doing rather than just what they are complaining about.
Right. It's behavior quantified. In a climate where economic models are struggling to predict the weather, looking at the actual granular portfolio data of a massive financial institution gives us a much clearer picture. Our mission today is to figure out how a bank can navigate all this macroeconomic confusion and, well, actually manage to smash financial expectations in the process.
Okay, let's unpack this, because looking at this Q1 release,
Yeah.
the top-line numbers are staggering. We're looking at an adjusted earnings per share, or EPS, that hit $1.11.
Wow.
Yeah, that is up 90% year over year, and it completely crushed the Wall Street consensus estimate of 94 cents. Total revenue hit $2.18 billion.
Which is a huge beat.
Huge. When you dig into how they pulled this off, it reads like the story of a company that woke up, looked around, decided to completely clean out its garage, focus only on the exact vehicle it drives best, and is now basically lapping the competition.
I love that framing because the architecture behind those massive numbers isn't about like some flashy new product launch. To understand their current success, we really have to look at what they deliberately chose to stop doing.
Right.
It is a textbook masterclass in addition by subtraction.
And that leads right into CEO Michael Rhodes and this overarching focus forward strategy. I mean, they essentially cleared the deck.
Yeah, they did.
They deliberately exited the credit card business entirely, selling it off in the first quarter of last year, 2025. And they completely stopped originating mortgages.
Just threw them out the window.
Literally took these massive chunks of traditional banking and tossed them to double down on their core strengths.
Which is a remarkably difficult decision for executive leadership to make.
Right. And I have to challenge that strategy for a second, because credit cards and mortgages are like the absolute bread and butter of the traditional American banking model.
They are.
So if you cut those out, aren't you leaving billions of dollars on the table? I mean, it seems almost reckless to abandon the two things everyone associates with banking.
It absolutely seems counterintuitive on the surface, but you have to look at the underlying mechanics of those specific businesses. Mortgages and credit cards are incredibly capital intensive.
Okay, how so?
Well, think about a mortgage. You are tying up hundreds of thousands of dollars of the bank's capital for up to 30 years.
Oh, right.
And credit cards require massive, constant marketing spend, intense customer acquisition costs, expensive rewards programs just to stay competitive. So by shedding those segments, Ally streamlined their internal operations practically overnight.
That makes a lot of sense.
But more importantly, they freed up a massive amount of capital that was basically just trapped.
It's like dropping sandbags out of a hot air balloon.
Exactly.
And you can see the immediate result of dropping those sandbags in their capital position. They reported their CET1 ratio jumped to 10.1%.
Huh?
Let's demystify that metric real quick. Regulators basically stress test banks to see how much of a financial shock they can take before they break.
Precisely. CET1, which is Common Equity Tier 1, is the ultimate regulatory measure of a bank's financial armor. The baseline passing grade, the regulatory expectation for a bank of this size, is about 9.1%. So by hitting 10.1%, which is up about 60 basis points from last year, Ally has built this massive concrete bunker of extra capital.
And a full percentage point of extra armor doesn't sound like much until you realize we are talking about billions of dollars in reserve.
Exactly. It means they aren't vulnerable to sudden economic shocks. And crucially, they aren't just hoarding this cash under a mattress. They are strictly deploying it only into the specific areas of their business that generate the absolute highest risk-adjusted returns.
So they stopped trying to be a mediocre everything-to-everyone bank.
Yes, and became a highly specialized machine.
And what's interesting is how that intense focus seems to be physically altering the corporate culture. It's not just like a spreadsheet exercise happening in the boardroom. They just hit the Fortune 100 Best Companies to Work For list, which is their highest ranking to date.
Yeah, that's huge.
Over 90% of their employees surveyed said it is a great place to work. And externally, they just met their famous 50-50 media pledge for men's and women's sports a full year ahead of schedule.
Which is brilliant brand positioning, especially given the explosive viral growth we are seeing in women's sports right now.
No, absolutely.
But mechanistically, when executive management sets a highly focused strategy like shrinking to grow and then actually executes it without losing their cultural soul, you get this intense internal alignment.
Right. The employees aren't pulled in a dozen different directions.
The whole company is rowing the exact same way.
So if you strip away the massive revenue engines of mortgages and credit cards, you create a pretty massive hole in your balance sheet. What exactly are they shoveling into that hole to fill it?
Auto loans.
Specifically,
Dealer Financial Services. That is their undisputed heavyweight division.
And numbers they put up in this division are wild. They processed an all-time record of 4.4 million consumer auto applications in a single quarter.
It's massive.
They originated $11.5 billion in consumer loans, which is up 13% year over year.
But they aren't just greenlighting anyone who walks onto a car lot, right?
Yeah.
41% of that massive volume is in their absolute highest credit quality tier, what they call the S tier.
Right. And the profit margin on those high-quality loans is incredibly healthy. Their retail auto-originated yield came in at 9.60%.
Wow.
But the real indicator of how well this machine is running is the risk metric. Their retail auto net charge-offs, the loans they have to write off as totally uncollectible, actually dropped.
Really?
Yeah, they fell 15 basis points year over year to 1.97%.
So wait, let me get this straight. They are lending out more money, they're getting higher interest yields on those loans, and fewer people are defaulting.
That is the trifecta of consumer lending.
But there is a glaring contradiction here when you zoom out. Industry-wide light vehicle sales in the U.S. were actually down 5%.
It is like a restaurant reporting its most profitable night in company history on a random Tuesday when foot traffic in the entire city is completely dead. If the auto industry is actively shrinking, how in the world is Ally breaking application records and expanding their loan book?
What's fascinating here is the psychology of their through-the-cycle approach with auto dealers.
Okay, tell me more about that.
Well, think about the auto finance world over the last few years. The pandemic hit, supply chains broke down, inflation spiked, and interest rates shot through the roof.
Chaos, basically.
Total chaos. A lot of major banks panicked. They tightened their lending criteria dramatically, or they just abandoned certain dealership networks entirely. They were fair weather friends.
They pulled the umbrellas away the second it started raining.
Yes. But Ally didn't. They stayed in the trenches. They acted as a reliable, consistent partner to these dealerships during the ugliest parts of the market cycle.
So now that things have stabilized a bit, the dealers remember exactly who picked up the phone when times were hard.
Precisely. Dealerships operate heavily on relationships and ease of execution. Because Ally proved their loyalty, dealers now reward them by routing massive application flow their way first.
So that's how you get 4.4 million applications.
Exactly. And mechanically, having that massive top-of-funnel flow is a superpower. It means Ally never has to scrape the bottom of the barrel just to meet a quarterly lending quota. They can be incredibly, almost ruthlessly picky.
Right.
They have so much demand that they can prioritize discipline over volume, just dialing their underwriting criteria up or down to target exact returns.
It's the ultimate luxury. having so many options that you only have to say yes to the absolute cream of the crop.
Yep.
But to be completely objective, it wasn't a totally flawless quarter in the auto space.
Mm.
Their overall net interest margin, or known I, came in at 3.52%. Management specifically pointed out that this number was slightly dragged down by a $10 million loss on lease terminations.
Right.
What is the mechanism behind that specific loss?
So this highlights a really interesting micro trend in the EV market. When Ally or any bank leases a car to you, they calculate a projected residual value.
Okay.
That's what they estimate that specific car will be worth 3 years from now when you hand the keys back. The bank needs to sell that used car to make the math work.
Right. And if the car is worth less than they guessed, the bank eats the difference.
Exactly. And this specific $10 million loss was heavily concentrated in plug-in hybrid electric vehicles, or PHEVs. The secondary market value for those specific hybrid models is dropping faster than Ally initially modeled.
Oh, I see.
So as these leases mature and the cars come back to the lot, Ally is taking a hit on the resale. But rather than dragging this problem out, they proactively accelerated the depreciation on select maturing leases for those hybrid models. They took the accounting pain immediately to clear the deck.
Okay, so it's a specific technology risk on hybrid residual values, but they adjusted the math to absorb the blow quickly.
Exactly.
So they have this massive dominant position with auto dealers. Does the monetization stop at the car loan, or does this focus forward strategy create a broader ecosystem?
Oh, the auto loan is just the entry point. That dealership loyalty acts as a Trojan horse for their next major profit engine, which is embedded insurance.
Embedded insurance.
Yeah, because Ally is already operating as the trusted all-in finance partner for the dealer. They have the perfect, frictionless distribution channel.
They aren't trying to sell you insurance while you're sitting on your couch watching TV.
Oh, no.
They are selling you the vehicle warranty and the protection plan right there at the dealership desk at the exact moment you were signing the papers for the car.
Exactly. The customer acquisition cost is practically zero because the buyer is already captive in the transaction. And you can see that mechanism paying off in the Q1 numbers.
Let's hear them.
The insurance division wrote a record $389 million in premiums. Their core pre-tax income for insurance jumped by $70 million year over year, hitting $87 million.
Wow. Now, in the spirit of keeping the X-ray machine honest, we should note that this massive profit jump had a little help from Mother Nature.
It did, yeah.
Last year, their insurance division got absolutely hammered by what management called 1 in 200-year weather events.
Yeah.
We are talking about catastrophic hailstorms that essentially act as a giant blender for a dealership's outdoor inventory.
Yeah, total devastation.
They didn't have those massive weather events this quarter, which made the year-over-year profit comparison look incredibly flattering.
The weather definitely provided a tailwind, but we shouldn't dismiss the underlying operational strategy. They are actively shifting their portfolio toward lower risk policies and higher deductibles to protect themselves from that kind of geographic weather concentration in the future.
Got it.
But you want to talk about truly staggering structural mechanics, we need to transition to their corporate finance division.
Yes, because looking at the data for this division, the numbers almost look like typos.
They do.
Their corporate finance portfolio grew 6% quarter over quarter to $13.7 billion. They are generating a 26% return on equity. But here is the stat that makes me stop and call a timeout.
I know which one you're going to say.
They have not recorded a single historical loss in this entire portfolio since 2019. Not one penny lost. And right now, 0 loans are classified as non-accrual.
It's an almost mythical track record in modern banking.
I genuinely have to call BS, or at least express extreme skepticism here. 0 losses in private credit since 2019. We have lived through a global pandemic that shut down the economy, wild supply chain inflation, and one of the most aggressive Federal Reserve rate hike cycles in American history.
It's been a rough ride.
Companies were going bankrupt left and right. How can they possibly claim 0 risk while pulling in a 26% return? Usually, if there is no risk, you are making a 4% yield, not 26.
It is a completely valid skepticism. To understand how they defy gravity here, you have to look at the structural mechanics of how they construct these deals. First, Ally acts as the lead agent for virtually 100% of these transactions.
Meaning what exactly, in plain English?
Think of it like a restaurant. Most banks in the corporate finance space act like diners. They just buy a slice of a massive loan that another bank structured on the open market, and they hope the chef cooked it right.
Okay.
Ally is in the kitchen. They are sourcing the ingredients, writing the recipe, and cooking the meal. They control the diligence, they dictate the underwriting standards, and they set the strict financial covenants the borrower has to follow.
Okay, so they have total control over the rules of the game. That's one layer of protection.
The second layer is their advance rate. They utilize incredibly conservative advance rates, averaging around 60%. Mechanically, this means if a corporate borrower pledges $100 worth of hard collateral, Ally is only lending them $60.
I see. So the borrower's underlying business would have to collapse and lose 40% of its total value, like a catastrophic, end-of-the-world drop, before Ally's principal is even threatened.
Precisely.
They have basically built themselves a 40-foot concrete flood wall in a market where most competitors only build 10-foot walls.
Exactly. And the final piece of the puzzle is who they lend to. They strictly focus on high-quality, scaled asset managers who have a proven track record of surviving multiple economic recessions.
Okay.
In fact, management made a very specific point to say, we do not chase growth. They just grow organically alongside clients who have literally been partnering with them for decades. If the client expands, Ally increases their credit line. It is relationship banking executed with ruthless mathematical precision.
Which brings us to the most fundamental question of this entire deep dive. To fund $11.5 billion in auto loans in 3 months and to support a $13.7 billion corporate lending portfolio, well, a bank needs cash.
No, absolutely.
You cannot lend money you don't have. Where does that massive, reliable pile of fuel come from?
Retail deposits. It is the absolute bedrock of their entire operation.
And Ally is the nation's largest all-digital direct bank. They're sitting on an astonishing $146 billion in retail deposits spread across 3.5 million everyday customers.
Massive scale.
They just clocked their 68th consecutive quarter of customer growth, which is up 6% year over year.
Yeah.
And in a banking era where we've seen localized bank runs and panic over uninsured deposits, 92% of Ally's deposits are fully FDIC insured. Retail deposits make up nearly 90% of their total corporate funding.
That specific funding profile is an incredible competitive moat. Having a massive, highly granular deposit base where 92% of the money is federally backed means the executives don't have to worry about a sudden digital bank run.
Right.
They can sleep at night, which allows them to focus entirely on making smart, long-term loans.
Here's where it gets really interesting, though. We are currently living in a highly competitive interest rate environment. Every regional bank and fintech app on the internet is fighting for your savings account, throwing flashy 5% yields at you.
Oh yeah, you see the ads everywhere.
But Ally actually reduced its liquid savings rates twice recently. And despite cutting the interest they pay out, their customer acquisition actually accelerated.
That is the magic of what economists call deposit beta.
Break that down for us. Why are customers staying when they could technically get a better rate elsewhere? It is like a streaming service raising its monthly fee but still gaining millions of subscribers.
Deposit beta essentially measures how aggressively a bank has to raise its deposit rates to match the Federal Reserve's benchmark rate. Ally's cumulative beta is sitting around 63%. But the reason they can get away with cutting rates without losing customers comes down to the psychology of friction and brand trust.
Nobody wants to deal with the headache of changing banks.
Precisely. Think about the friction involved. To chase an extra 0.1% in yield at some unknown startup bank, you have to migrate your auto pay for your mortgage, redirect your employer's direct deposit, update your Spotify and Netflix billing, and learn a totally new app interface.
It's exhausting just thinking about it.
It is. Ally has built a top-tier digital experience and cultivated massive brand authenticity. I mean, remember the sports pledge?
Right.
They are essentially monetizing convenience. Customers are incredibly sticky because the platform works flawlessly, and the friction of leaving just isn't worth a few extra dollars a month.
They have built a loyal army of depositors who tolerate slight rate cuts because the utility of the bank is so high. That has to be an absolute dream for their profit margins.
It is, and there is an even bigger margin tailwind coming over the horizon. The data shows that $18 billion in certificates of deposit, or CDs, are maturing in the first half of 2026.
Wow, $18 billion.
Yeah, these are CDs that customers likely locked in a year or two ago at much higher peak interest rates. When those mature, Ally will simply reprice them at today's lower rates. That is going to massively reduce their overall cost of funds, acting as a slingshot to push their net interest margin back toward their long-term goal in the upper 3% range.
So what does this all mean? When we zoom out from the spreadsheets and look at the whole picture, Ally is a bank that successfully dropped the dead weight of traditional banking.
Yep.
They are leaning incredibly hard into auto loans, exploiting their embedded insurance channels, building zero-loss corporate portfolios, and funding the whole thing with highly sticky digital deposits. They are winning. But despite all of this, the word management used over and over on the earnings call was measured. They're remaining highly measured.
Very measured.
Why? Because their baseline modeling for the rest of 2026 assumes absolutely zero Federal Reserve interest rate cuts until June of 2027.
That is a remarkably conservative, defensive posture compared to what Wall Street was projecting just a few months ago.
Oh, totally.
Ally's leadership isn't wearing rose-colored glasses. They are watching higher oil prices slowly drain the consumer's wallet at the gas pump. They are looking at mixed economic signals, like the fact that seasonal tax refunds only rose about 11% year over year, which is drastically lower than the 20% bump most economists had baked into their models.
Right.
They know they're flying a very fast plane, but they are keeping both eyes glued to the weather radar.
Which brings us full circle, right back to that broken X-ray machine we talked about at the top of the show. I want to leave you, the listener, with a philosophical puzzle that emerged directly from CEO Michael Rhodes during this call.
It's a paradox that really cuts to the core of how we understand the economy today.
Rhodes pointed out a massive, glaring disconnect in the data. If you look at consumer sentiment surveys, where pollsters ask people how they feel, the data says the American public is miserable.
Yeah, deeply pessimistic.
People are furious about inflation, fearful of a recession, and just pessimistic about the future. But when you look at Ally's actual portfolio data, the real-world MRI of millions of accounts, it shows a consumer base that is remarkably strong. People are continuing to spend, they're applying for car loans at record numbers, and most importantly, they are reliably making their payments on time.
The words simply do not match the music.
Exactly. So here's the thought I want to leave you with. If consumer actions completely contradict their complaints, well, what happens to the businesses that panic and alter their entire corporate strategy based purely on the complaining?
That's the million-dollar question.
If a company stops innovating, stops hiring, or cuts its services because sentiment surveys say the sky is falling, while the actual credit card data shows people are still buying, aren't those companies just handing their market share over to the competitors who stayed focused on the math? Think about that the next time you hear someone say the economy is failing. Are they looking at the X-ray, or are they just listening to the noise?